Knowledge Class. Some knowledge about futures contract you should know. What are mark price and last traded price? Mark price. A pricing indicator for contracts, typically used to measure the true value of a contract and calculate margin and liquidation prices. The mark price is usually calculated based on a specified pricing mechanism, which often includes reasonable premium or discount factors to ensure that market price fluctuations do not have a significant impact on futures pricing. Last traded price. The price of the most recent transaction for futures contract. This price can reflect the real-time price in the contract market, but it may be affected by factors such as liquidity and market depth, so in some cases, it may deviate from the true value of the contract. What is funding rate? The funding rate is a mechanism to measure the difference between the spot price and the contract price, used to adjust the interests between contract traders. The funding rate is calculated regularly at certain intervals and adjusted based on the difference between the spot price and the contract price. If the contract price is higher than the spot price, traders shorting the contract will pay the funding rate to traders longing for the contract. Conversely, if the contract price is lower than the spot price, traders longing the contract will pay the funding rate to traders shorting the contract. The adjustment of the funding rate aims to encourage the market price to remain consistent with the contract price, reducing the risk of market manipulation and providing a fair trading environment for traders. What is project circulating market value? The economic mechanism of a project depends on its white paper. Generally, it may include allocations for the project team, early investors, community airdrops, and project treasury. If a project's white paper lacks transparency, it is more likely to be manipulated. For example, the $POGI white paper gives the community significant freedom but also provides significant freedom to market makers or institutional investors. They can freely acquire chips at low levels and cannot be diluted once acquired because there is no mechanism for additional issuance or linear unlocking. What is isolated margin versus cross margin? Isolated margin and cross margin are two common types of margins in crypto trading. Isolated margin. In isolated margin mode, each open position has an independent margin, and the losses between positions do not affect each other. This means you can hold multiple positions simultaneously in the same account, each with its own margin, which helps to reduce overall risk. If a position's losses exceed its margin, only that position will be liquidated without affecting other positions. Cross margin. In cross margin mode, the balance of your entire account is used as margin, and all positions share the same margin pool. This means the risk of each position is shared, and if a position's losses exceed its margin, it may lead to the entire account being liquidated because all positions share the same margin pool. What is liquidation fee? Liquidation fee refers to the fee incurred when a trader's position is forcibly liquidated in certain financial transactions. This fee is typically charged by the trading platform or broker to offset the losses or costs they may incur during the liquidation process. The specific calculation method and amount of the liquidation fee may vary depending on the trading platform, financial product, and market conditions. Generally, traders should carefully understand the fee policies of relevant trading platforms or brokers before trading to avoid unnecessary costs. What is slippage? Slippage refers to the difference between the actual execution price and the price expected by the investor during a trade execution. This difference may be caused by factors such as market fluctuations, liquidity issues, or trade execution speed. In general, slippage may result in profit loss or increased trading costs for investors. Slippage may be more common in high volatility markets or low liquidity products because in these cases, price movements are more rapid or order execution may be more difficult. To reduce the risk of slippage, investors can take measures such as using limited orders, selecting trading periods, choosing products or trading platforms with higher liquidity, etc.